Good morning, listeners. TGIF, as we every time say, it's Friday, and welcome back to Almus Market Mornings with Shikhar Garg. And folks, as we have been talking about, historic times in financial markets is well justified by the kind of synchronized and high pace rate hike action we have observed by the central banks. Now, well, that's also brought an end to the era of negative yielding debt, which was at USD 18 trillion around a year ago and is zero now. On the data front, US posted strong job numbers, bringing in some dollar strength back against the majors, and it happened just when rupee had started to show some strength, as we see in the past 2 days. So, on the other hand, European nation was also talking about the kind of terminal rates that can be observed, and Villeroy was found speaking about the terminal rates being reached by May. So, JK, there's a lot of updates. And what do you think about this kind of negative building debt getting back to zero, strong job numbers, and terminal rate for Europe?
Yes, yeah, I think that Japan was the last one to join the party of hiking rates, and it took long time in coming, but eventually they have relented because it so happened that the Bank of Japan remained the sole buyer of the bonds in the market, and they had to remove the dysfunctionality from the bond market. That was one reason, and also the inflation started to rise in Japan as well. So I think with the rate hikes still on the cards from Europe and US and even UK, we are not likely to see any more slippage into the even zero yield, let alone a negative yield. I think Japan is the one which has lastly pushed it up into the positive territory. But all said and done, yields this week have been relatively less, volatile compared to actually the currencies, because there is a little bit of policy uncertainty from the US in terms of where the terminal rate will be vis-a-vis market expectations. In fact, Bullard, who is a known hawk, yesterday made a statement kind of neutral, where he actually said that the rate hikes from the last 1 year starting to have some impact on the inflation. But at the same time, he also, mollified it by saying that the rates will remain higher for longer. Stocks had started to recover from their negative zone in midway yesterday in US after a Bullard statement, but eventually they caved in because I think the sentiment on the technology sector, which has once again seen a 1.5% fall, is still weak. And also the earnings season, which will start very soon, isn't likely to paint a very good picture. So stocks are negative steadily in US. Europe, after 2 days of rally, Europe was kind of neutral, but in Asia, China and Hong Kong have been doing well on reopening, optimism, and also economy doing better in the coming days. But as I said, the currencies have been more volatile than any other markets this year. We had two-way swings, big since the start of the trading on the 3rd of this month, and initial up move, or rather the initial down move in the dollar has been met with renewed buying, and it has been seen that all the rallies in the Euro and GBP have been sold into, because that's the way market has been positioned. Because the last 3 months before the new year, we had seen the currencies gain quite a bit against the dollar. Dollar index itself had fallen almost 10%. And yesterday's data from US, both on the trade account, where the deficit fell quite a bit, and in fact there was a lower import and a higher export of services, which accounted for the lower monthly trade deficit. And that's good news for the GDP number for Q4 in the US as well. Then we had also a positive news on the employment from US, where the ADP job numbers surprised once again, to the upside by coming at 2,35,000 increase as against the market expectation of 1,50,000, and the previous number was 1,82,000. And the job resurgence has been seen mostly in service industries and mostly in medium and small establishment, whereas as we have been updating, large establishments like Amazon and Facebook have been cutting jobs. So overall picture of job market is good because weekly jobless claims also fell as much as 90,000 from 2,25,000. And that again, these things actually add up to a good jobs number to be released today. We will also have a release of ISM services. We have to see, because services is still holding up in the expansion territory in the US as per ISM report. Although S&P Global, so we are having two reports, every month on the manufacturing and services sector, and S&P Global, which is more comprehensive, actually is showing a negative number for both manufacturing and services, whereas in ISM, the service sector is still holding up. We have to wait and see how this turns out today. Besides that, we'll also have a factory orders data. So a lot of data to chew on today, and so gives enough reasons for market to be in ranges, at least for the initial part of the day. And yes, as I was saying, the currencies had big swings in the last 2-3 days, and but important to see that euro has been holding up. It supported 1.0520, and cable, or rather GBP, has been holding up over 1.19. And these are probably likely to come under threat if the job numbers comes stronger than expected, and because that will have an implication for the monetary policy in the US. In fact, as I said yesterday, one of the members is indicating a terminal rate at 5.4%, whereas market is discounting terminal rate to be below 5%, and even a rate cut to happen in the second half of this year. And I think market will remain in broad ranges, not a narrow range like year-end times, but we'll find some time to get a bigger direction. I do feel the dollar has seen a significant peak, but does not mean that we'll have a straight line down move, even though the market is already beginning to debate when the Fed will potentially start to cut the rates. Hikes are yet to come. So we have to remember that we are at 4.5 and it can go to 5.25. And so that keeps supporting the dollar. And there are also concerns about global growth. And a combination of these means that some amount of safe haven buying in the dollar will continue. But eventually, I feel once the Fed policy turns around, dollar will have a much larger down move. And coming to our own Indian rupee, it was a fresh trend in the short term, breaking below the support at 80 to 60 and closing below it. That was more important. It did have some follow through post bank covers close, but again, one more crucial support is emerging at 80 to 40. Most people are watching this support as crucial because a breakthrough that can see much needed correction in USD/INR, which has been almost on the one way. The trigger for yesterday's move obviously started with the big fall in the oil price, and some of the analysts already starting to project a lower CAD than 3%, which earlier projections had gone as high as 4%. And apart from that, some modest lows were also seen. One more factor that we can probably expect is that the ongoing correction in the Indian stock market, which has already reached about 5% from the peak, if it continues to correct further, it can lure fresh investments from FIS. All in all, a better balance between demand and supply in the USD/INR can lead to some temporary strength in the rupee, but a more sustainable down move for the USD/INR will definitely depend upon how the deficits and the flows pan out, as well as the US monetary policy. Thank you.
Okay, JK, that is quite good. And yes, folks, yesterday we did see some bit of strength in INR against the dollar, as majorly being reasoned out by the fall in oil prices as well as the decreasing CAD projections, one of them being SETI, as we mentioned yesterday. On the other hand, as DK mentioned, for the currencies, we can expect to have some ranged action before any larger moves are in place. And like he mentioned, the moment we see a pivot from the Fed on the policy front, we can expect some bit of dollar strength to dissipate and majors to come back to their uh, fore. And on the other hand, on the data side, as JK mentioned, strong job numbers are a bit on the divergent side from the kind of trend all the large corporates in US have been showing on the layoff front. And like we have been seeing, currencies being more volatile than any other market majorly has put a lot of risk on the FX side for a lot of corporates. So folks, we believe you have risk management practices in place. If not, it's a good time to start, and we keep managing our risk on the FX front, because these times will continue to have some bit of volatility eventually. That's it for today, folks. We shall come back again on Monday as we bid adieu for the good weekend that you guys are about to have. Thank you so much for listening.